The average American only spends 2 minutes per day working on their personal finances. I think that is crazy. And yet, 50% of people want to be more successful or have a better handle on their personal finances. That math just does not add up. And I think one of the problems with it is that personal finance is not taught from a young age. So I'm going to teach my 8-year-old
Hi.
some 3 personal finance concepts that I think anybody can grasp, and then I'm going to test her at the end. And if she passes it, she might get a prize. Okay, so personal finance. What are you supposed to do with your money? What is saving and investing? And how do you make money? You think you can understand that?
Maybe.
Maybe. I like the attitude. Okay, so step 1 in personal finance, make a budget. So a budget is a plan for how you're going to spend and save your money. If you get $10 a month in allowance and you have to spend $5 over the course of that month, how much do you have left over?
$5.
So you have to budget to spend the first 5, and then you have to budget what to do with the money that's left over. So you start a budget with the money that you bring in, which is called income, be your allowance. Then you subtract out your necessary expenses. That $5 be your expenses. Maybe it's for Roblox Premium, or maybe it's for something that you have to pay. Does that make sense? Okay, so the remainder is called your free cash. And this applies to anything in life. This could apply if you're making $1 million a year or if you're making $10 a month in allowance. It doesn't matter, the math scales. What's important is that you account for every single one of your expenses and you pay those first. Because if you don't pay your expenses, they begin to pile up, and then you go to debt collectors, and then you go into all kinds of other financial hardships that are unnecessary if you just pay them to begin with.
So, like, if I had $10, I spent $5, and I want to get a new stuffed animal that's $20, and I get $10 per month, and I spend $5 per month, I could wait 4 months to get that stuffed animal.
That is setting a goal and saving for it. Perfect. Okay, so after you do that, you're allocating what I'm calling your free cash. That $5 per month is your free cash. And what do you do with that free cash? Well, the first thing you do with that free cash is not buy a stuffed animal. It's build an emergency fund. Do you know what an emergency fund is?
So, like, if you get, like, an extra bill and maybe you didn't know that you have to pay it and you thought you already paid it, you could get out of your emergency fund and use that.
Yeah, or what if you lose your job and you don't have income for a few months? How are you going to live?
Emergency fund.
Emergency fund. Or if you get a big bill, or if you get into a medical emergency.
Dun, dun, dun.
So that's the first thing you should do with your money. Build an emergency fund. An emergency fund should be about 6 months worth of living expenses. So if your living expenses are $5 per month, you should have 6 times 5 as your emergency fund. So you
5,
have
10, 15, 20, 25, 30. That's $30.
$30. Or if you're an adult and your living expenses are $5,000 a month, you should have $30,000 in emergency fund. It takes some time to build this up, but you should allocate this at the beginning of your budget. You should always put money into your emergency fund. Additionally, as you build up your emergency fund, pay down the debt, pay down any money you've borrowed. This is kind of important to prioritize these this way, because if you don't have an emergency fund, but you are paying down your debt, you're still at risk should anything bad happen to you. Money. The next thing you want to do with your money is, like I said, you want to pay down what you've borrowed. Money you borrowed is called debt. So let's talk about debt or liabilities. So a liability or debt is money you owe to someone else, or it's something that costs more to own than the value you receive from it. So for instance, a car. Most people, whenever they buy a car, they go borrow money from a bank, and then they give that money to the person they buy the car from. And they then owe the bank back the same amount of money that they borrowed plus interest. And so interest is the cost of borrowing money.
So it's like that times 2?
So if you borrow money from somebody. You have to pay them that money back, plus you have to pay them a fee or interest on the money that you borrowed from them. So if I loan you $100, I expect you to give me back that $100, right?
Yeah.
But what if I also charge you interest on that $100? Then I expect you to give me that $100 back plus interest.
Let's say interest is $20. Then I'll have to give $120 back.
Yeah, that's actually a really high interest rate. That's 20% interest in that 1 year if we took a year to pay me back. That's why it's important to pay down your liabilities first, because that money, those liabilities are costing you more money than the value that you actually have in them. So if that car that you own is worth $10,000, but you have a loan to the bank for $10,000, you're paying back the value of the car, the $10,000, plus the interest that you owe the bank in order for them lending you the money. So it's more expensive than what it's worth. That's why it's important to pay down these liabilities early, because they're costing you money. What you want to do, allocate your free cash, build an emergency fund first, pay down those debts, those liabilities, because they're expensive. You want to, if you have a job, this is not necessarily for you, you want to contribute to your employer matching retirement accounts. Now, if you have a job and your employer matches your retirement contributions, you should take advantage of that. That is free money. You should take advantage. Do that third, though. Build an emergency fund, pay down debts, then contribute to your employer matching retirement accounts. And lastly, set goals and save for that stuffed animal. That's the order, which I think, and a lot of other people think, you should allocate your free cash. Free cash is after your expenses. So now let's talk about assets, okay? An asset is a thing you own that can appreciate in value or help you make money. You can invest into assets. Maybe you invest into stocks or land, even a house. These all can increase in value over time. So an asset is something you own, something you buy, they can increase in value over time. So if you buy a share of a company and that company is growing, that share of that company could grow larger over time. Or if you buy a house and over time that house could become worth more money. So that's an investment, that's an asset. An asset is something that can make you money, that has value and can appreciate. Okay?
So, like, you can sell it?
You could sell it. Yeah, that's how you realize your gain. Okay, so if you bought a house for $100,000 and then you sold it for $150,000, how much money would you make?
You would make $50,000 because you already spent $100,000 on the house.
So $50,000 is how much you made. So now let's talk. That's investing your money into a house. Same thing can happen with any other asset that you invest your money into. So now let's actually get into what investing is. So you see this gray box.
Yes.
And you see the arrow going from the bottom left to the top right.
Uh-huh.
So on the left vertical side is risk, and on the bottom is return. Now, whenever you invest, you don't want to take on more risk than is necessary. So risk means the odds of it failing or going to zero or losing value. Okay, that's what risk is, the odds of it losing value.
That's bad.
That's bad, yeah. A return is how much money you make. A return is the $50,000 we just mentioned. So you don't want to invest in something if you're not going to make a return that's equivalent to the risk. Okay? So that means on that black line that you see going up and down, that is the ideal place to invest.
Okay.
So we now have like a red zone and a green zone. So if you're going to invest, do you think you should invest in the red zone or going to invest in the green zone?
Probably the green zone.
Well, I gave it away. So that means that you want to always invest below that black line, on or below that black line. Because if you invested above the black line, you would be taking on more risk than the return is necessary. So that means that if everybody in the market has the same access to the same information, then everything should be priced right on the black line.
Okay.
So everybody in the market means anybody that has money and wants to invest in something.
So it's not a risk or a return?
No. It means that equal access to information means that all assets should be perfectly priced. So if something is priced too high, then you'd be taking on more risk than is necessary, or you'd be taking on less return than that asset actually should be getting. So there's different levels of risk and return. Kind of the lowest risk thing that you can do with your money is you put it into a savings account. A savings account is an account at a bank where they pay you a tiny bit of interest. So they pay you a little bit of money for you to put your money into their account and not mess with it.
So they pay you money or you pay them money?
They pay you money. Nice,
That's
huh?
good.
Yeah, well, it's not much. So that's really low risk. It's really low return. So the next thing is a bond. A bond is something that corporations or governments issue so that they can fund projects or something else. And they promise to pay this money back with interest over a certain period of time. These are a little riskier than savings accounts, but not really. If you buy the government bonds, then they're pretty safe. But see, they're almost always going to fall on this perfect risk return line because there's really no asymmetry to the information associated with bonds. Savings accounts are the same way. Then you look at stocks. So you remember we bought Roblox stock?
Mm-hmm.
So that's buying a piece of the company that operates Roblox, the game. And those are a little more risky because you don't know how that company is going to do in the next few years. You don't know whether or not how good their leadership team is. You don't know how long their product is going to be actually in demand. Roblox is a lot of fun right now, but is it going to be fun in 5 years? Hopefully, maybe. So it may be kind of risky to invest in that company, right? It'd be kind of risky to buy some of that company with your dollars and expect to get that money back plus interest, plus a return. So that's what a stock is. A stock is a piece of a company that we buy a part of. Roblox is the stock we use as the example. Now, the next thing that's even riskier are options. Options are essentially contracts that allow you to do certain things with these shares of stock. They're definitely riskier, but they also have higher returns. And the last thing that's kind of in vogue and everybody knows about right now is cryptocurrency, like Bitcoin or Ethereum. If you were to invest in them in real life, the return potential, really high. The risk, also pretty high. So if it falls on this line, which also takes your preference into account, you could buy it. So how is money made? First thing, if you're the one lending the money, then you're the one getting paid the interest. You're the one getting paid the cost of borrowing that money. Also, dividends. If you buy a share of a company and they make money, then they distribute the money they make back to you because you own a share of it. That's called a dividend. And then just pure gains, right? I mean, crypto gains, option gains, capital gains. Who knows? All right, so here's a quick recap. Make a budget. Pay down your debts and make an emergency fund. Allocate your free cash to assets, not down payments on liabilities. Save, save, save. Invest intelligently below the black line, which means essentially don't take any unnecessary risks. And then you'll become financially free and you can do whatever you want. You can travel around in a van. Go do whatever you want. You are free. All right, so you ready for the test?
Yeah.
Okay, so question 1. What is interest?
The cost of buying money.
Yeah, essentially. It's the cost. It's how much it costs you to borrow money or how much somebody pays you for borrowing your money. Okay, question 2. What should you use your money for first?
An emergency savings account.
Nice, exactly. What do you do with it next?
And then you save up for
Then you pay down your debts.
Yeah.
All right, question 3. How do you make money with your money?
You invest.
Invest. You buy assets that pay you money back, huh? Mm-hmm. You buy assets that appreciate, or you buy assets that pay you interest back, or you do any of that. Mm-hmm. Okay? And last question, where should you invest on this graph?
You should do it below the black line or on the black line. You don't want to take too big of a risk.
You don't want to take unnecessary risk. Awesome. All right, great job.
Okay.
Good job.